Welcome to this explainer. Today we're diving into the absolute high-stakes domino effect of the procure-to-pay cycle's buy side. Every single business out there, no matter the size or industry, has to buy things to operate. But how a business actually buys those things, well, that determines whether it runs like a well-oiled machine or a leaky bucket that's just bleeding cash. So we're going to look really closely at the vital first half of this entire process.
Here is our roadmap for navigating this cycle. We'll start with the domino effect itself, move through requisition and approvals, tackle the whole vendors and fraud situation, look at purchase orders, and finally wrap up with the golden rules of segregation.
All right, let's jump right into Section 1, the buy-side domino effect.
Think of these 4 stages like a row of dominoes. You've got identifying the need, getting it approved, setting up the supplier, and finally, issuing the official order. And here's the catch. If just one of these falls incorrectly, like, say, a missing request or an unapproved vendor, those errors compound all the way down the line to payment. It's a massive chain reaction. Every single downstream control in your accounting and finance departments depends entirely on these 4 steps happening exactly right. Imagine a purchase order that doesn't reflect the negotiated price. That's going to cause an absolute headache when the invoice actually arrives on your desk.
So, moving right along to Section 2, Stage 1, the requisition. Okay, so when a department realizes they need some goods, services, or maybe a new asset, they can't just run out and swipe a corporate card. They have to document it. And there are 3 non-negotiable elements you absolutely need in that documentation. First, a crystal clear description of exactly what is needed. Second, a solid estimate of how much money is actually going out the door. And third, a real business justification explaining why the company actually needs this to keep the lights on.
Now, the crucial point here, the absolute golden rule, is that bypassing this process completely skips budget checks. And that creates a direct, massive risk of unauthorized spend. If employees just start buying things without an approved purchase requisition or PR, they're basically operating completely outside the audit trail. And honestly, this is exactly how budgets get completely blown out of the water on, emergency ping pong tables or totally unvetted software subscriptions.
Let's look at what happens next in Section 3, Stage 2, Requisition approval.
Once that PR is submitted, what happens? Well, approval authority absolutely has to scale upwards with the financial risk. It just makes sense, right? A small spend can usually be signed off by a team leader, just to keep things moving quickly. But as that dollar amount starts creeping up into the mid-range, you're definitely going to need a finance manager's sign-off to make sure it aligns with the budget. And for significant, massive commitments, executive authorization is absolutely required. They're the ones checking against policy compliance, budget availability, and genuine business necessity.
But watch out, unapproved spend is one of the absolute highest risk failure points in this entire cycle. Seriously, if these thresholds are ignored, or worst case scenario, if someone actually approves their own requisition, your essential independent check just vanishes completely into thin air.
So to prevent that unauthorized spending, we have a very clear rule. The requisitioner must not be the same person who approves the PR. This is literally the very first and most fundamental segregation of duties rule on the buy side. The person asking for the cash cannot be the person who says yes to the cash. Now, if you're in a super small team where full segregation is just tough to pull off, you absolutely must use compensating controls. Things like exception reports on self-approved items or independent after-the-fact reconciliations.
Now things get really interesting. Section 4, Stage 3, Vendors and Fraud.
Setting up a new vendor requires absolute precision. You can't just type in a name, punch in a routing number, and call it a day. No way. From the legal name down to the tax ID, these fields are literally your first line of defense against sending cash to the wrong place. The legal name ensures the wire actually goes to the right legal entity. The bank account? That must be heavily verified because it's the ultimate destination for your company's cash. Then you've got the tax ID for compliance and accurate contact details, which are super vital for dispute resolution and verification callbacks.
And you really have to watch out for these 2 villains. First, we have the inside job, fraud pattern 1. This is where someone inside your company who maybe slipped through the cracks of access segregation creates a completely fake supplier just to pay themselves. Yikes. Then there's fraud pattern 2. This is an external threat, like a hacker sending a wildly convincing email pretending to be your actual supplier. They usually ask to update their bank details right before a massive payment run. It happens way more often than you think.
So it's the ultimate defense here. It's requiring dual authorization for any changes and independently verifying bank details over the phone. Let me repeat that. Never, ever act on an email alone. You must pick up the phone and call the supplier on a known, independently sourced number to confirm any bank changes. On top of that, newer change vendors should really be audited on a monthly basis, and absolutely only vendors on the approved list can ever be paid.
All right, moving on to Section 5, Stage 4, Purchase Orders.
The purchase order, or PO, is the ultimate shield in this process. It is the actual legal contract sent to the supplier, locking in all these critical details and giving the green light to receive invoices later. It lays out the approved vendor, exactly what items or services are being ordered, the authorized volume, the commercially negotiated price, where and when to deliver, and of course the payment terms, like say net 30 days. Without this PO, your accounts payable department has absolutely no basis for matching and approving invoices later on. It's like flying blind.
And that brings us to this incredibly fun term, maverick spend. This is the absolute villain of purchasing chaos. Maverick spend is exactly what happens when money goes out the door without that vital, approved purchase order attached to it.
Basically, a high PO coverage rate means you've got disciplined control. Every dollar spent has a strong authorization trail, and you can easily perform a three-way match when invoices start rolling in. But high maverick spend? That is a super dangerous symptom of a business that has totally lost control of its budget. Purchasing is happening completely outside the system. And maverick spend isn't just going to earn you a slap on the wrist from an auditor. Every single rogue invoice represents company money being spent completely in the dark.
Finally, let's wrap up with Section 6, the golden rule of segregation.
This overarching philosophy really binds this entire explainer together. Simply put, no single person should ever control more than one step in this chain. The person requesting the purchase cannot approve it. The person approving the requisition cannot be the sole approver of the final purchase order. And critically, the person managing the vendor master and changing bank details must be completely 100% locked out of approving invoices and executing payments. Each point of separation acts as an independent check on the step right before it. It's brilliant, really.
I'll leave you with this provocative thought to consider about your own organization's vulnerabilities. Knowing how easily these dominoes can fall if one single person holds just a little too much power. Who really controls the vendors in your system? Seriously, take a close look at your buy side today, because locking down control at the very beginning is the only way to ensure absolute security at the end.